So chapter 4, cost volume profit analysis. So with this chapter, you're using cost volume profit, or as we call it, CVP, and it's a very useful tool. It helps managers make decisions, demonstrates the relationship between costs, the volume, profit and loss, and it helps the company determine how much they need to sell each month just to cover their cost or break even. And then it helps managers decide how sales volume would need to change to achieve various profit levels. So just as an example, if you're throwing a student party and say the university has offered a lounge for free and you're going to get a DJ in and it's going to cost $1,000 for the one night, and you're going to provide some snacks and soft drinks, that's going to cost $5 per person. And you've decided you're going to charge $10 for each person to attend. So now what you need to figure out is, in order to cover your fixed cost of the DJ, how many tickets do you need to sell to break even? So you want to cover all of the cost of the DJ plus the cost of the snacks. So what you need to do is you look at your selling price, which is $10, and then your snacks are $5, so it's $5 per person that's going to contribute to the profit. And then you want to take your DJ cost divided by the $5 per person to figure out how many people you need to attend. So it's going to be a big party. 200 people would have to pay $5 each just to break even and cover the cost of the DJ. So when we're looking at this, your DJ, that would be considered fixed cost, and the ticket price is your selling price, and then the snacks would be your variable cost. So your sales less your variable cost will give you contribution margin. So then if, as you could see from the previous example, if you wanted to calculate break even, the formula is your fixed cost divided by your contribution margin per unit. So some assumptions that we have to consider in using CVP. A change in volume is the only factor that affects costs. So managers have to think about their cost and classify them as either variable or fixed. And costs are linear through the relevant range. So when we talk about relevant range, say for instance, you're operating a factory and the maximum number of units it could produce is 10,000 units in a year if it's running 24 hours a day, 7 days a week. So if you go above that level of production, then you're outside the relevant range and you're going to have to probably find another building, and that's going to increase your fixed costs. So when we say relevant range, that's what we're talking about. So another assumption is inventory levels won't change and the sales mix of your products will not change. So that's some of the main assumptions that are built into the CVP analysis. So take for example Kay's poster. So she sells each poster for $35, and the poster has a variable cost of $21, so it's costing her $21 to make the poster. She also has fixed costs of $7,000. So she's currently selling 550 posters, and her relevant range is up to 2,000. So even though she's only doing 550 at the moment, she could go up to 2,000. So the contribution margin income statement, so this is kind of like the long way to do it. So you would take your 550 posters, multiply it by your selling price, $35. Her variable expenses is $21 times 550. And then you can see the contribution margin is $7,700. And you can double check it, 550 times $14 per unit. Then she has fixed expenses of $7,000. So her operating income is $700. So she's not making a lot of money. She's doing a little better than break even, but not a whole lot. Let's consider another scenario. What about if she sells 650 posters instead of 550? So here you see that obviously makes a difference. So contribution margin is the 35 less your 21, the cost of producing it, gives you a contribution margin of $14. Then what you want to look at is the contribution margin times 650 posters, 9,100, less her fixed expenses, is going to increase her operating income to $2,100. So obviously, if she can sell them, that would be a good thing for her to do because she's going to make more money. So when you're looking at contribution margin ratios, you can look at it from a unit perspective or on a percentage or ratio perspective. So we've just gone through the example where it's $35 selling price, $21 variable cost, contribution margin $14. And you convert that to a percentage, so 21 divided by your 35, 60, and then 40% contribution margin. So you can use either the unit costing or you can use the ratios when you're doing analysis. So say, for instance, if you're looking at 650 posters, you know the contribution margin there is going to be 40%. So you know that's going to be $9,100. So another scenario you can use your CVP for is to look at what are the implications of different sales levels. So say if she generates $70,000 in sales, you know the contribution from that is 40%. So $28,000 less the fixed expenses will give her an operating income of $21,000. And of course, you can verify this by kind of working backwards and doing it the long way, and you still come up with the same answer. So obviously it was quicker to do it the method that I just showed you. So another concept that's really important for a business is to look at the break-even point. So break-even is when you are just covering your cost and you're not making any profit at all. So at this level, your fixed expenses are equal to your contribution margin. So we'll just move to an example. So there's three ways that you can go about calculating break-even. You can use what I call like the long method. So it's your selling price, less your variable costs, less your fixed cost, and the operating income would be zero. Or the shortcut, which is the whole point of this chapter, is to say, how much do I have to sell in units to break even? So the fixed expenses plus the operating income, which would be zero, divide by your contribution margin per unit. So here you can also calculate break even in dollars. So it can be units or dollars. So in this case, again, if you're looking to calculate sales in dollars, you're going to divide by the contribution margin ratio. Whereas in the previous example, we're looking for sales in units, then you're going to divide by contribution margin, the dollar value of the margin on a per unit basis. So of course, companies want to do more than just break even. So CVP analysis is very useful to help business owners and managers determine how much they need to sell to make a certain amount or a target amount of profit. So in this example, they want to make $4,900 in operating income. So what you're trying to do here is figure out what the sales are going to have to be to achieve that level of income. So here you're taking your fixed expenses plus your $7,000 plus your desired or targeted operating income of $4,900, and you're dividing that by the contribution margin ratio. So when you divide by the ratio, that's giving you the sales in dollars. So now if you want to see how many posters she'll have to sell, then you just divide the $29,750 by the $35 per unit, and that will show you need to sell 850 posters. So the formula is just demonstrated here again, and is just showing the calculation, as I mentioned. So you could look at identifying the sales in units. So again, it's the same numerator, your 7,000 and 4,900, but this time, because we're looking for units, we're going to divide by the contribution margin in dollars. So $14 will give you 850. So businesses typically will do some sensitivity analysis. We'll look at different options. So we call it what-if analysis or sensitivity analysis. So people will look at, well, what about if I increase my fixed costs and maybe, in order to sell more of my product? Or what about if I increase or decrease the selling price? What if my costs, my input costs, my materials, if my supplier increases that, what will that do? And if you're selling multiple products, what about if you change your sales mix, sell more of product A than product B, for example? So we're going to have a quick look at some of those scenarios. So here, Kay has determined if she runs an advertising campaign that costs $1,000, sales will increase to 600 posters from her current 950. So this is her existing situation that we've already reviewed. So now if you increase the fixed cost by 1,000, so here's what happens. So she can sell more posters because she's going to sell 650 posters at $35 each. It's giving her a contribution margin of $8,400. But to get that additional contribution margin and additional sales, she had to spend $8,000 instead of $7,000. So that leaves her with less operating income. So in this particular situation, even though she's going to sell more posters, it's not beneficial because it's costing her $1,000 in fixed cost to get those extra sales. So in that case, of course, you would not do that. Now we look at a scenario where your variable costs would increase $23 from $21. So this is the original scenario. So if your costs increase and then the sales are also going to go up to 650 units, what will happen? So that's another scenario that you could consider. So another scenario is, what about if the sales mix changes? So assume she's selling a regular size posters and large posters. So the regular, that's the one that we've already been working on, the $35 in selling price and the variable costs of $21 and so on. So what you're doing here is you take the contribution margin of both products on a combined basis, so it's 160. And in total, they're selling 8 posters. So the contribution margin on a weighted average basis is $20 per unit. So now you want to consider, well, what happens if that distribution changes? So here, if you want to calculate break even, you want to figure out how many of the regular posters and how many of the large posters will she have to sell to break even. So the total number of units, so we're looking at a contribution margin per unit of $20. Because we're looking for break even, it means our operating income would be 0. That's the idea with break even. You're not making any money. So just to break even, she would have to sell 350 posters. So the next thing then you want to look at is how much she is going to earn from these posters. So if you want to figure out here is what is the break-even sales of regular posters. So it's 350. And assuming the sales distribution, if she's selling 8, so 5/8 times your 350 will give you the 218.75, and then for the large posters, their share is 3/8 times the 350. So this is your break-even sales of regular posters and large posters. So you just multiply that out and you're looking at total revenues here of $16,000. And that concludes the review of the PowerPoints for this chapter, and also remind you to review the examples, the demonstration videos, where I go through more examples on how all these calculations are done.